Go for it.
Yeah, we are
Awesome.
live.
Looking good, Nihit.
Yup.
We are just
Yeah.
discussing that. Anyways, hello everyone. Welcome to another episode of Capital Mind Live, where we decode and discuss the after effects of important events that happen in the markets. Today is one such day. In fact, the entire month of March is like that, isn't it? A lot is happening in the global markets too fast, too soon. The US regional banks are under stress. We had seen the collapse of Signature Bank, SVB, Credit Suisse in the last 3 weeks. Amid this fiasco, everyone shifted their focus to the Fed. There were several questions till yesterday that what will be the Fed stance? Will the concerns of financial stability on one side or the high inflationary scenario on the other side? Which side will the Fed choose to take? Well, the verdict is out. Fed had increased the interest rates by another 25 basis points, its ninth hike since March 2022, taking the interest rate to 5%. With that context and background, let's welcome our very own Deepak Shina and Nihit into our discussion. Hello, guys. How is it going?
Awesome. Hi, Nihit. कैसा चल
Yes.
रहा है?
But yeah, feeling good on the inverted side of the curve.
The inverted side of the curve. I
Shouldn't be
like it.
that for long, bro. It shouldn't be. It shouldn't stay there for long. So anyway,
Chalo,
so
koi nahi. It's good.
Good.
guys,
So
before
let's
we
Um,
proceed to the discussion, sorry, Nihit, you
yes.
are saying something?
yeah, let's I am saying let's jump into it and
Yeah, yeah.
let's see what the Fed is
Please ask questions
doing.
on the
Perfect.
side whenever you guys. I will
Yeah.
just keep them interspersed and all that.
I'm just keeping that little formal. So, guys, we are proceeding into the discussion. The chat box is open. Please post your queries. We'll make sure to address them all. And okay, so Deepak, quick question. Your first reaction on the quantum of the rate hike, and then we'll take it from there.
I think, see, what happened in the last 2 weeks was a fear that SVB will go down, this will happen, that will happen. And the Fed opened a new program. It was called the Bank Term Funding Program. This is like emergency repo in Indian parlance. A repo is when the RBI actually gives money to banks for securities. Typically, it gives some
I think we lost Deepak's audio.
Yeah.
Yes.
Maybe.
There seems to be a problem with my network for some strange reason. So if I go out again, I will disconnect and come back. You guys carry on, continue. But you guys can hear me?
Yep, we
Yes,
can.
yes. We can hear
Okay.
you.
So there's some issue with the office internet today. So what I think is starting to happen is the feeling that Fed is on QE again. So therefore, Fed should not hike. But what the Fed is saying really is that boss, like, inflation is still high. We do we will give you more money, but we will give you more money at a very high rate. And I'll come to that towards the end of this presentation. The rate at which banks are able to get money today is very high compared to earlier. So they're getting liquidity at a high price. Now, Madan asks, is BTFP a loan, a new money printed or a loan? So the concept is always like this, okay? They, imagine the whole Federal Reserve as like, there's a wall, there's a Berlin Wall, kind of thing between, say, East Germany, which is the Fed, and West Germany, which is the rest of the economy. Let's give you an example. So you can't you have two different sides of everything. Whatever money the Fed prints, nothing happens because only the banks can participate in this side of the wall. There's only so because banks can borrow more, yes. There's a corresponding account on the economy side of things. Banks have more money. Now, what will you expect banks to do with more money? To be able to lend it out. Now, if they're able to lend out money and banks invent money, so if you give them 100 rupees on the Fed side of things or $100 on the Fed side of things, they can lend $1,000 on the side. What happens is they have 10. They have to keep like a certain portion as reserves against that lending. This is like a provision of some sort and all that. And it can, I'm just using 10x, but you can actually do much more than that. So there are required reserves required for every loan. The reserve requirements increase based on the type of loan you make. If you make a personal loan with no collateral, the reserve requirements are higher. If you make a mortgage-based security, you buy a mortgage-based security, the reserve requirements are lower. And if you buy a government security, the reserve requirements are even lower than that. So on this side of the wall, there's a much lower, there's a much smaller propensity to, increase inflation. That is on the side of the wall, that is the RBI, the Fed here in this case. The Fed printing money just gives money to the banks, and they're not able to lend, do any serious amount of lending. The money sits back with the Fed as excess reserves. Okay, so now Fed doesn't actually do anything of this sort in terms of it doesn't disclose data anymore on what is excess and what is required reserves. For some strange reason, they stopped publishing this information. However, what happens when the Fed is giving such a program is always new money is printed. So any money that is paid to the Fed is no longer money. So if you borrow money from the Fed and paid an interest rate, that money, including the interest, is vanished. So that's gone from to thin air. There's no more money of that sort. If you if you borrow money from the RBI, it always has to print money and give it to you. And when you repay money, it will always take that money and extinguish that money. So the money comes in and goes. This is the reason why when the Fed sells securities, it recently started, last year it started selling the government bonds that it owns. As it sold those securities, the money vanished. So both its assets, which is the bonds, and the liabilities, which is the dollars, came down. So essentially the Fed balance sheet is dynamic. Whenever you want to borrow from it, it prints. Whenever you return money to it, it gets back. So there's a large amount of this new money that we're talking about, right? You actually get the Fed gets a 4% interest rate for creating this money and giving it to banks. Banks then pay that 4% and give it back to us. So it's all money on this side of the wall. It's not yet come into the real economy. It's not. It's essentially what has happened is one bank which has lost deposits says, "Boss, I'm losing deposits." Fed is saying, "Fine, take money from me." Though where's the deposit gone? It's gone and sat in some JP Morgan. JP Morgan like, I don't want any more deposit. आ गया. So deposit आ गया वो, he'll say, okay, I can't lend it, so I'll put it back as excess reserves or whatever, and maybe so the deposit base at JP Morgan increases. It doesn't actually go back as excess reserves because the money is sitting inside of the Federal Reserve. Think of money moving from one bank to the other effectively as money moving within the Federal Reserve deposit system also from one bank to the other. So when a bank needs money, it borrows because it needs to have money enough to keep its depositors at bay, right? So what happens now is that in some of these banks, because the Fed pumping in money is not enough for confidence, JP Morgan is also saying, on this side of the wall also, I'll give you money. Don't worry, I'll lend you money. So the interbank system is trying to provide confidence more than the Federal Reserve by itself. So yeah, I think there is a concept that new money is being printed, but it's not actually going into the economy. It's just sitting within the banking system in some kind of a localized kind of way. This is not resulting in inflation. It will not result in inflation.
Just to give you an example, so First Republic Bank, around $18 billion went out. The deposits went out from First Republic Bank to the major banks, Bank of America, JP Morgan, Wells Fargo and all, of which JP Morgan has given $5 billion back to First Republic as a deposit. So unsecured deposit. So basically it's again rotating within the system only, within the banking system. Deepak, one quick question on this. So JP Morgan putting $5 billion as deposit, will it actually make much difference? Because you are actually giving a loan. What First Republic Bank or other banks need is equity. But these guys are giving to pay up the loan, they are taking new loan. So is it okay, or is it how sustainable is that? So that's my
So
quick question.
it's fine because what you're solving is a liquidity problem right now. If there is a solvency problem, that's a different issue. That's when you need equity, right? So
Yes, yes, understood.
equity is for loss absorption. So if First Republic is not really able to pay back because it makes losses, that's a different thing. First
Understood.
Republic's problem is liquidity. It has lent to people who have given it mortgages or their own mortgages from people. Those mortgages, for some strange reason or for whatever reason, cannot be sold right now at short notice. So you can't just. So it's like somebody you taking your housing loan and the bank telling you अभी पैसा वापस दे. You'll be like अभी नहीं दे सकता यार घर बेच के तेरे को दूंगा ना. So you will sell the house only then can you return the money to a bank. So therefore, you will have to take that much time. But if you're a bank, you can't tell people abhi nahi dunga. You'll be like abhi dena padega. So I'll borrow from JP Morgan and give you. Don't worry, whatever else I have, I'll handle. The loans and all I'll handle over time. So this is how the liquidity problem can be solved. It can be solved by debt or
Understood.
new debt. It can equity solves a problem of I have lent money. I am not going to get all the money back because there's a default. That default may be 10%. So I'll get only 90% of my money back. You want 100%. So how do I give you 100% when I only got 90% back? Now I need that 10% to be bridged by equity. Saying I'll get my equity in and then I'll have enough assets to meet my liabilities. That is how bank financing works. From an equity perspective, it solves a solvency problem. From a debt perspective, it's an equity problem.
So on
Got it.
on this thing, in the case of Silicon Valley Bank, it had deposits for which are
One
yielding
year.
1.5% with the mortgage backed securities, and when it took a loan, it would be paying higher interest rate of say
No. So a deposit for a bank is a loan. For the bank, it's a loan.
right.
Hmm.
So
For
when
you,
it
it's a
takes
deposit, right? So if you have deposits in a bank, for the
right,
bank, they have taken a loan from you.
right. So
They are
they
paying
so that
zero
right. Okay. So then they invested that loan to get
into
1.5%,
yeah, yeah.
something which
Now,
was giving
what
them
should have
1%.
happened? What should have happened in the SVB case was if you start noticing that boss, ये 1.5% का 3% हो रहा है,
Right.
3.5% हो रहा है. You buy something that hedges your risk. You buy something that says, okay, boss, I lost, okay, whatever, 1.5 to 3 I've lost, but above 3 I shouldn't lose. So you do something called a fixed to floating swap. You have a fixed payment of 1.5% that you will receive. And you want to convert that to a floating. So you buy something where you pay fixed and receive floating.
Right.
You may pay fixed of 4.5 and receive floating of 5.5. Whatever, or usually the rates will be the same as soon as you book it. But if the floating rates go up, you still pay fixed 4.5. Floating can become 5.5 and 6.5 and all that stuff. So you make the differential between the two as this thing. So what happens is if you do a loan match, so if you have a loan of say $100 million, loan book of $100 million that you have lent out at 1.5%, you take a $100 million fixed floating swap. So the idea being on that 100 million, you'll pay, let us say, 4.5 million fixed. That is 4.5 million is 4.5%. But the party on the other side will give you a floating, which is linked to some overnight rate. That overnight rate has gone up 2%. जो तुम्हारा mortgage based security है, which was giving you 1.5%, now it is giving you 3%. You've now said that 3% तक का loss तो ठीक है. Anything more than that is being made up by this fixed floating swap that I'm getting. This more than that fixed floating wala swap thing is something they didn't do. They never did. Even First Republic. I'm like, dude, what? You expected deposit rates to stay constant all the time. People will take out the deposits. So then you'll have to get new deposits at higher rates. So you will not make money if you don't have these swaps in place. And they are not able to lend more. So, for instance, if you're making new mortgage loans at 4.5%, I understand, or 7%, I understand. But you're not making new mortgage loans because the demand for the new mortgages from the economy have reduced somewhat. So, given this, you've got a situation where
Got it.
the
These are called
1.5.
interest rate swaps, is it?
Sorry, say that again. Inheet, are you there?
His
Krishna, are you
question
there?
was, are these called interest rate swaps?
Yeah, well, yeah. I mean, these are the interest rate swaps. Technically, are it can be fixed, floating. It can be term. It can be so. The word swap will usually have an interest rate in it,
Cash
and
flow.
it could have a foreign currency in it as well. So a fixed floating swap is a traditional interest rate swap, but a fixed floating plus cross currency swap can be a combination of both a currency and this thing. In this case, you're only talking USD, but the USD swap market is very, very active. It's very, very active.
Nice. Guys, we got
Indian
some
swap
interesting.
market. Indian swap. India में भी यही problem है. Take some of the largest banks in India. You have, say, HDFC Bank. Okay, HDFC Bank has 15 lakh crores in deposits, 13 lakh, I don't know, some crazy number. But most of those deposits are callable on demand. लोग अभी भी जाके HDFC बैंक से अब भी पैसा वापस दो करके पैसा निकाल सकते हैं. And HDFC obviously does not have loans that they can demand back anytime. तो गाड़ी का लोन लिया, घर का लोन लिया, जो भी whatever, घर का तो वो देता नहीं है, but he owns it by buying them from HDFC. But let's assume they have a bunch of loans. You can't go to those people and say, give me back your money. People, my depositors are asking for money. So HDFC Bank also has the same asset liability mismatch, except they say that नहीं अपना Deepak has taken 2-year deposit, fixed deposit. But Deepak can come back in 1 year and say मैं penalty pay करता है, मेरे को पैसा वापस दे.
Having said that,
Right?
Deepak, the reserve ratios of Indian banks, CRR plus SLR is at 22% when compared to the US banks, regional banks, especially at 8%. So,
See, that is also a misnomer because reserve ratio रखने से क्या होगा? I'll give you an example of why that's a complicated thing. SVB had reserves of literally 50%. So liquidity reserve of 50% because they consider a mortgage-based security a liquid asset. Is it that liquidity was available at a much lower price and a much higher yield? That means I can sell it if I want, but I'm not going to get $100 for every $100 that I invested. I won't get only $70 for every $100 that I invested. I was allowed to pretend that the $100 is $100 when it's actually not worth that much. If the central bank had forced down these accounting requirements, saying, boss, if the bond loses value, then you have to take the hit. Every central bank should do this. They should forcefully ask banks to take the hit on bond movements beyond a certain extreme. So 5% range rakh lo. So within 5%, I don't care. But anything more than 5%, boss, you're taking the hit. So that means your security should not lose more than 5% from the time you bought them. If it loses more than 5%, you should take the hit on your balance sheet, even if you call it hold to maturity. कुछ भी कर, मेरे को कोई फर्क नहीं पड़ता है. मेरे को, I only am interested in whether you're taking the hit or not. So if you should, central bank should enforce this in general, that hold to maturity also should have this.
okay, Deepak, we'll just take one question before moving into next topic. So, DG is asking what happens to the trillions of dollars which was yielding almost negative interest rates all over in the last 1 decade in current scenario where the interest rates are increasing.
Cool. So I think this what happens to the $1 trillion in negative interest rates mostly is in Europe. And I don't know what is happening here. Europe is a complete blind, crazy thing. So who bought those government securities at negative interest rates? I don't know. How much they're losing today is probably a truckload because there also yields have gone up. The biggest problem in the future is going to be Europe, not America. We talk about SVB, other information. Europe is a black box. Nobody knows what's happening, and it is full of really rotten stuff. It has been so for the last 15 years, except the ECB and all of them have protected the banks from the blow up. Now, if they're no longer willing to protect, banks are going to blow up. Credit Suisse is already gone. I am sure more banks in Europe will have serious problems. And I am telling you, next 4 5 years will be one bank after the other saying, oh, I'm in trouble, I'm in trouble, I'm in trouble, and all that. So it will keep happening. So you should almost say, boss, Europe, just avoid Europe. Okay, just visit there, say hello. Don't invest in that place. It's just just horrible that way. So
cool. So let's move on to the next topic. Okay, so this is interesting. So what happened was Janet Allen 2 days back in a conference with American Bankers Association. So what she said was basically, in fact, I would like to play 1 minute clip of her saying that. Please allow me.
Commitment take the necessary steps to ensure that depositors' savings and the banking system remain safe. Our approach had two main pillars. First, we worked with the Federal Reserve and FDIC to protect all depositors in the resolutions of Silicon Valley Bank and Signature Bank. The steps we took were not focused on aiding specific banks or classes of banks. Our intervention was necessary to protect the broader US banking system. And similar actions could be warranted if smaller institutions suffered deposit runs that posed the risk of contagion.
That's what she said. What she said was kind of how we saved SVB and Signature Bank depositors. If needed, we'll also save the similar kind of small institution bankers. Now, how the media or what others got interpreted is this kind of a blanket insurance on every banker, irrespective of $250,000 FDIC insurance. And 2 days later, that is yesterday, this happened when the Congress asked Ellen that okay, so Ellen actually started the speech and she clarified that okay, we are not going to consider blanket insurance. Now, as you can see, the entire market was like okay, and it was in fact bullish based on the commentary, not the action, but the commentary of Powell. Commentary of Powell was more of a soft. It's not hawkish; it's still soft. So market was bullish, but the moment when Ellen said that okay, we are not considering blanket insurance, everything started going down in the last half an hour of the market. So as you can see, so in a way, it is market is sensing that okay, the worst is not at over. The regional banks, the stress in the regional banks are still there, and maybe it may come back uh, within the near future. So that is that's the confusion in the last 2-3 days between Powell's speech and Janet Yellen's speech. Deepak, any view
Yeah,
or any?
man, there's a lot of drama. Yellen should not. Yellen is like not very media friendly on this front. Okay, she just makes statements and then it's very scary because the market is reads too much into what they say. Of course, they'll save the banking system if everybody goes down, but if some random bank goes down, they will not possibly save it. See, SVB didn't need to be rescued. It was just rich people with money in that bank who will suffer. But so what? With 130,000 people, out of which 100,000 people were fine. It was only some 30, 40,000 people that had problem. 20,000 those were mostly companies. But here was that everybody else in the banking system, everybody else would say, "Oh, if what if my bank is next?" And therefore the contagion spreads. So when you have a contagion issue of that magnitude, then yeah, you might go rescue the banking system. But otherwise, banks go down all the time. There are banks that went down in 2018, 19, 20. So you saw when those banks go down, nobody said, "Oh my God, the whole banking system will die." They went down. Some people lost money because they didn't have. They had money more than $250,000 in the bank, which caused the problem. And I mean, which is now which is protected by default in an SVB. If there's a system-wide issue, I think they'll protect it. But to read so much into this sounds a little extreme. And you know what? They don't have to. If confidence builds up relatively quickly now, I don't think we are going to see a major drama happen in the US. But um, I think they should be careful about how they say things because to say that there is no insurance is also a bad thing. To say that there is insurance is also a bad thing. Best thing is to say we will see. We will be there case to case to protect the system from a systemic issue. Right now, if your feeling is that well, I should take my money out and put it into a large bank, then That's a principle of confidence. That means you don't have enough confidence. There'll only be a few banks, so they have to generate that confidence required to bring the banking system back on track. That right now there is seems to be a little bit of fear, and I'm saying little bit because there's not a lot of fear. The U.S. stock
Yeah.
market continues to, relatively speaking, go upwards despite all of these challenges. I feel that stock markets will not go up if the markets are so fearful. Everything will be fearful. In fact, even bond yields came back yesterday after the Powell speech, and
Yes.
this thing. So you saw that. Yeah, we'll talk about those. Yeah.
Cool. Deepak, we have a question from
Yeah.
Karan. First of all, hey Karan, welcome back. So now that Fed is showing signs of reversal path, which tenure in Indian gilt funds do you think is best for going into passive duration portfolio? And why do you see Nifty paying? Where do you see Nifty PE going forward?
So there is no signs of a reversal path. They just said that, boss, shayad we will not improve the increase in interest rates going forward. That's all they said. Maybe interest rate rises are done, but we may take other steps for liquidity. Liquidity maybe because they start selling government bonds, mortgage-based securities, whatever it is to reduce this thing. But they're actually increasing. They've already increased rates, and I think it's fair to say they've increased rates quite a bit. To increase from 0% to 5% in a year is a little radical, even for the Fed. So they've already done quite a bit. So I don't think they're showing a reversal path as yet. They've just said, "Ki boss, we've done so much. Go. If it gets more, if inflation keeps increasing, I'll increase even more." That's very clear. But I think in India, things are slightly different. So forget what the Fed is. India inflation is slowly starting to come down, and it's not going too much. It never hit the 9-10%. It went to some 7+% and then came back. The rest of this year, you're probably going to see inflation come down even below 6. So it's possible that Indian long-term yields may have peaked. Short-term yields, I think, still have a way to go. So long-term yields are the 10-year, for 20-year, 30-year kind of bonds. They are between 7.3 and 7.4, 7.5%. Two things will happen now. Credit spreads will widen so that corporate credit will go to 8% plus. It's still 7.8, 7.9, early 8%. We're already seeing some corporates now starting to borrow at 9% plus. So I think corporate spreads increase and widen. So the difference between the government bond and the corporate bond will go from the 20-30 basis point, 0.2, 0.3% difference now to nearly 1%. The second one is that shorter term loans and shorter term borrowing will probably see a higher rise. So we might see shorter term even go higher. Today there was an auction by the RBI for 1 year paper. 1 year paper is 364 day and 182 day and 91 day T-bills. All three were sold today. The 182 day T-bills were 7.12 or 7.13% roughly. The 10-year bond is at 7.34. So there's a very small difference between the two. So I think the shorter term may even go higher. It may, 182 days can become 7.4, 7.5%. So in this context, what you want to do is sit around in the 1 to 5, 7 year kind of duration. Even 10 years is okay if you have a longer time horizon. But in the so the curve now basically, instead of being flat, you might see a curve towards, well, in your case it will be a curve towards this way, because the shorter term will see a higher rate and the longer term will see the same rate as it is, as the yield as it is, even if the RBI increases rates once more. So I think right now is the time to slowly start building duration. We've started to do that in Capital Mind.
Yes.
But
Yes.
so where's the Nifty PE? Wait, no, one more month we'll see results. When you see results, earnings will go up. If earnings have gone up, PE will come down for the same price. So I think no point predicting. Let's wait and see results. March is usually a good month.
Yep. So let's go to the next topic.
Yes. So this is more of a question. So Deepak, as we see right now in the US yields, the 2 year and the 10 year, which is an indicator which shows that if the 2 year yield is higher than the 10 year one, then you're into an inverted yield curve. And in that at that point, it's a leading indicator that, boss, now the next coming times are going to be a time of recession. And that's why this has been, I've been hearing a lot of this on social media and on Twitter, that once the Fed pivots and once they stop cutting rates, stop raising rates, and maybe they pivot and getting the rates down, the stock market is going to have a fall. This is basis historical data, and the 2 year, 10-year yield, the inverted yield thing, also based on the historical data. So how do you look at this? Is it so simple and streamlined that history is certainly going to repeat itself because of the whole structure of how bonds and equity markets are, or are there other factors at play which could change things this time around?
Good question. I don't know the answer to the question just yet because I know only one thing. The Fed will not pivot to cutting rates just yet. They will pivot to, at best, keeping rates the same. So if rates are the same, does it change a lot for the industry? Does it because if you keep rates at 5%, that's a lot of rate. I mean, that means risk free is 5%. फिर तो मतलब, how do you kind of invest in equity in the longer term?
Right. So if the Fed pauses, so do you think RBI, so we have a policy on 3rd April, so do you think RBI will or can, of course they can, but will they decouple and will they say, okay, let us do our thing and let us cut because our inflation is low? Or will they still look up to what US is doing and follow them, which is a safe thing to do and a conservative thing to do?
So I think at best, even the RBI will pause. It won't dramatically increase rates. Decrease rates. So at best, it will pause. When it pauses, the long end may come down a little bit because people are expecting कि अभी rate come होगा at some point. And they will look at next prints of inflation. Inflation right now at 6.44. So it's still higher than the RBI requirement of between 4 minus, so 2 to 6% is what the rate of inflation should be, right? So I think we should be careful that we shouldn't expect the RBI to suddenly start dropping rates suddenly. Unless India has a recession, there's no reason to.
Right.
Yeah.
So because we have an election coming, the recession seems unlikely that we'll
No
ever.
recession hota nahi. India doesn't get recessions. It's too difficult to have a recession in India. So many moving parts, so much inefficiency. So you don't get recessions very easily. COVID was a recession. You literally had to trap people in their houses to cause a recession in India. Otherwise, nahi hota hai.
True. I think we have a chart in the next slide where we are showing how the rates, how the rates were constant for some time before they went up.
So this
Sorry,
is
I'll quickly
basically
go through this. This is the Fred database in the US, which talks about bank credit in the. So people are worried, oh, printing hoga, there's a lot of inflation. I think there's one person who talked about this particular thing. Is the no crisis would justify the economics? No crisis even now justifies the economics of crypto. This crypto is no economics. The idea of the Fed's U-turn in QT, there is no U-turn in QT. There is currently a bank funding facility that's been created. The tightening is on. You're seeing rates at 4.88% for this liquidity. It's like you want money, take it, it's at a high cost. This actually means that the tightening is on, and just the liquidity is being made available at a very high price. But the idea of quantitative easing is to make liquidity available at a low price, not at a high price. So if you make liquidity available at a high price, it's like hafta. You have to pay hafta to operate your business, and that is a seriously high amount of money that you're taking or an interest rate that you're taking. Look at the credit growth. It has dropped dramatically from a 10% kind of growth just in January of this year to the top graph down to 4.5%. 4.5% is the lowest in the last, I think, since 2020 is around the lowest credit growth that you're seeing in the banking system as a whole. Now, America is slightly different. The people borrow from the money markets and all that stuff. But still, if you look at growth of the money supply or anything like that as of March 8th, you're going to see that the money supply in the actual economy is actually not much at all. So if your money supply itself or the credit growth itself is 4.5, by the way, India is at 70. and we are seeing 6% inflation. Okay, that's because India has relatively higher productivity growth compared to the US. But if you look at the US with a 4.5% credit growth and sharply dropping in credit growth, the trends matter. So credit growth is sharply dropping. You are not seeing inflation. In fact, what you're seeing is QT. So I would say if there's a case to be made for crypto, this is not it. In fact, we will see very soon why this is not it, because this sudden hype and jump and oh, there's going to be hyperinflation. Kuch nahi hone wala. We are going to see a more deflationary impact of this because bank regulation is going to get stronger. People are going to crimp down on lending. The kind of lending that will happen going forward will be at a much higher rate. And the way that people are currently managing their finances will have to change. So in all probability we are seeing deflationary impulses, not inflationary ones. Yeah. Okay, we can go to the next slide, I guess.
Yeah. So we have the context here is that we have an MPC meeting on April 3rd. So that is and what will be the RBI? What can RBI do on the back of Fed stance yesterday? But the question is that Deepak, I just want to pick your brains on one thing. I remember the forward rate for USD INR used to be around 3.5-4%. So a couple of years back, 2-3 years back, when the interest rate when used to be at 0.5% interest rates, and our interest rates used to be at 4.2 and all. The 1 year forward is roughly 3.5 to 4%. But now, if you see, taking our Fed at 5% and we are at 6.5. So literally, the forward which used to be forward rate at 4% has narrowed down to 1.5. So what implications? Yeah, because 5 as of today, Fed is at 5, and as of today, RBI is at 6.5 1 year forward. So the spread 6.5 and 5, the spread has come down, narrowed down to 1.5. So what will be the implications of such? I mean, on USD INR, that is one thing. That is a broader question. And straight away, what can RBI? What will be the RBI stance on April 3rd?
So I think RBI will raise because that's how they do things. They only raise, but and plus they have a reason. Their upper limit on inflation is 6%, and we're still at 6.44. So it's fairly large. Differential is large. So I mean, as in it's only 6.44, only 44 basis points, but they still remain high, right? So they will want to reduce that down to the point where inflation goes to 6. They don't have to because I think it will go naturally, but I think they will because the ECB has raised 50 basis, the Fed has raised 25 basis, so they might also raise 25 basis. That's what my feeling is. But if you look at the USD INR 1 year forward rate today, right now, it's about 84 rupees 12 paisa. Today, the rupee, which did very well, okay, to be honest. If you see the rupee, that's at 82 rupees 28 paisa. So if my 1 year forward is 84 rupees 12 paisa and current is 82 rupees 28 paisa, I'm paying 1 rupee 90 paisa as a premium to sell the dollar after a year or to buy the dollar. So to buy the dollar with a 1 year view forward. The market expects a depreciation of 1 rupee 90 paisa on 82 rupees. On 82 rupees, 1 rupee 90 paisa is roughly 2.5%.
2%, yeah.
Yeah. So 2.2, 2.3%. So 2.3% is the premium that even the market is demanding for a 1 year forward in the rupee. This used to be 6%.
Yeah.
This is also because this narrowing of this spread is also because of how the inflation differential is between the two countries and the interest rate differential is between the two countries. Today, the interest rate differential between America and India was 4.5% in the US, and now it's become 5% in the US and 6.5% in India. So difference is 1.5%. So the rate has fallen to 2.5. That's all. I think that's the huge differential that is we're seeing in what it was 1 year ago to what it is now. Is the USD INR differential has also come down to meet the lower spread, and the spread has also come down because inflation is pretty much equal between the two countries now.
Got it. So Deepak, let's take some questions.
Cool.
there is this question by Christus Divyan. He's asking, there is a huge quantum of FII shorts. I don't know how we could verify this data, but is that an indicator to be taken seriously, and what can we understand from it?
You can't really take something much about it. So, see, FII shorts in the system are um, could be a position of, say, arbitrage. The difference between the cash and the future is an arbitrage position that they may be able to take. Today, arbitrage positions are quite interesting. When you look at arbitrage funds, they're yielding about 7.5%, 7.27 something percent. So you're able to get 7% in an arbitrage situation where otherwise an FII cannot participate in the debt markets. So they might be able to use this concept where you buy the stock and sell the future in order to get short-term debt um, exposure in India. Short-term debt exposure at 7% in India is fantastic because short-term debt in the US is at 5%, right? This 5% has increased. I mean, the differential between the 2% is fairly reasonable enough to be able to do this arbitrage between the rupee and now, and you're doing 1 month at a time. So if in a month you're getting a 7% yield, it's a very good differential. So maybe that is one part of the short part of the exposure because India doesn't allow FIs to participate in short-term debt products. So this is one way. The second way is, and it's complicated because if more and more people start to participate like this, you'll see more inflows than outflows. The second part is there are outflows. So FPI, if you look at the FPI numbers, apart from that, that Rajiv fellow who invested in Adani with about 15,000 crores, net of that we have seen if you remove that, ignore that, you've seen 7,000 crores go out of the Indian FI thing in March alone. So March is roughly 23 days done. So you're still seeing 7,000 crores go out. This is a problem because obviously, money going out means they could be short from an actual short perspective. Now, this actually tells you something because once you get the funda that FIs are short or increasingly short, there are two things that happen. First of all, FIs being short is usually not a great indicator. They have been short through the best bull markets and they have been short in bear markets. So it doesn't give you any indication of whether they're right or wrong. Second one is it could be an arbitrage position, so you don't know. The third thing is if it's actually a real position, they can switch out of it and back into new things very, very fast. Now, one thing that I would say in general is people look at the short positions that they've created in the futures market, but that does not reflect how they behave in the options market. So it is possible that in some cases the short positions may have a counterbalancing option position which is long. I haven't seen the data, but I mean generally there is a fairly large amount of put writing concentration. So if I short a future and I write a put, it's like a covered short. So I expect the market to go down, but not too much down. I don't expect the market to go up too much. That's what they're telling you when they're doing a covered put. So this will appear like a short in the futures market, but if you take the options position out, it's not necessarily a deep short. So I mean, I don't think we should consider it that seriously right now. And remember, they've been very wrong in the past. They were short most of 2020 until November, I think, November or December. And the market went up from the bottom, it went up nearly 100% in that time frame.
Today was the bottom, Deepak. March 23rd. Tomorrow, so yeah, March 24th was intraday bottom, but closing bottom was today. Yeah, March 23rd. Let's take one last question. Since we are talking about interest rates and all, Vasuraj is asking, can an Indian invest in US bank FD to lock in US bank FD high rates?
Yes, I think you can, but your problem is going to be the interest rate. So the currency rate exchange. So the currency appreciates by 2%. Today, by the way, the currency Okay, this is the NSE. This is the CCIL. You can look at this and see how the system. Okay, here you go. This is where we are. It's gone to 82 rupees 28 paisa, which is 31 paisa below. 31 paisa is 0.5%. So let's say you got 5% in USD. You have now got 4.5% in rupee terms. The rupees appeared at 31 paisa. Let's say rupee goes back to 80. And don't tell me it can't go. It can easily go. It has gone in the past. It has corrected quite substantially the USD INR itself. If you look at earlier times of so investing.com, and look at USD INR over a very long period of time. If you look at the USD INR chart, let's see a weekly chart for Max. No, Max is a little too much. Yeah, there have been many periods in which the rate for the rupee, once it was 48, came down to 39. Once it was 50, it came down to 43. This is a 20% appreciation. Okay, 20% between 2008 top and 2011. In 3 years, the rupee exchange rate went from 50 to 43. That means even if the US dollar were giving you 5% a year, in rupee terms you got zero. Because 5% a year for 3 years, 15-16%, rupee appreciated 20%. So nothing, you got nothing for 3 years, right? Similarly, if you look at this time, which is 2013, it went to 65, came back down to 59 within a year. So to go to 65 and come back to 59 is again 10%. That if you make 10% in 1 year interest and it comes back to that much, then you have a problem. Here also we're sitting at, I think, here you go. It's 74. Why does it show me only 74? It doesn't sound right. Oh, I have to go to the right. Okay. So in 2018, it went to 74, came back down to 68. 6 rupees. Again, that's nearly 9%. So effectively, rupee has seen appreciations of 9, 10, 15% in a year in the past. If it happens now, you go and buy a US deposit for 5%. Rupee appreciates by 9%, which has happened in the past, as I can show you in the graph. You will lose money on a US deposit in rupee terms. Don't think dollars now, think rupees. Then I don't think it's a good idea.
Deepak, one small observation on the same chart. So always rupee depreciated 1 year before elections, central elections. So let's say 2015 elections, 2013.
Always. See, 99 there was elections, there was nothing. Then 2004 there was elections, but yeah, I mean it started to come down from 2002 itself to 2004. 2009 is here. 2009 is roughly election time is here.
So 1 year before elections year. So if the election year was 2009, 2008 it will depreciate. 2013 it will depreciate. It had depreciated.
No, but that's only 2 years. In fact, 2018,
it has
rupee will depreciate as in it will fall, is it, or it will go up?
Yes. No, rupee will depreciate vis-a-vis USD. It's just an observation. That's
not true. I'll tell you why. Because 2019 it came down. It went up the year before.
No. So
2013,
1 year election year.
See, 2009, by the time there were elections, the market bottomed out in 2007. I don't think this is true because in 2004, for instance, there was no appreciation. There was no appreciation at all. In fact, there was a depreciation of the dollar. There was no appreciation of the dollar. There was no, rupee didn't rise. This is 1/5/2004. Rupee has not risen much. 99, which was the previous election, rupee didn't move. It moved up in 97, and that was because of the worldwide crisis. So I don't think this is true that rupee rises.
There's a speculative theory around it, which I read in 2013.
I remember writing about it in 2007. Ki nahi hai. Because 2007 also they they said rupee will now rise because of this thing. Of course, it rose because of 2008 crisis, not because foreign people are putting in money for Indian elections. I think we overrate ourselves. The Lehman crisis was the biggest crisis of the world, and if the rupee had not risen at that time, it would have been very, very strange. So we थोड़ा conspiracy theory है बस. Just
The theory is that people are saying to fight elections, the politicians bring in money, so that's why it depreciates. And
I think the politicians keep money here. If the money has gone out, they keep money outside. उधर से कुछ नहीं आता इधर. Nothing. I'm telling you. Why would you do this? I mean, first of all, it's difficult to take money out of India. You bring
now
it back.
Right. Now we have electoral bonds, so we don't need.
Correct. I don't think. I don't think people will do this. Even if there is corruption, it does. And plus, it's too insignificant. The stuff that happened in the past was much smaller. We were much smaller in nature. I mean, Lehman crisis में पैसा जा रहा है. If you are saying that's elections, I don't know. I mean, I don't think that makes any sense.
Okay, so but we digress, and before we end, Deepak, there is a question, which is a standard question which we get every time. So, and we all know the answer, we know very details of it, but I keep liking asking this to you. So, when is the mutual fund coming, Deepak? And what will be the first fund? You have to spill the secret. What will be the first fund?
We'll talk when it happens. All of this is like, don't predict, react wala fundana. You have to don't predict only. Just wait for it to happen. That's when it will happen.
Right.
It takes time.
So we are in process. We are in process, and we are waiting for the approval, just like everybody else. So when we'll get it, we'll announce on Twitter, maybe like right away. So we'll not wait for any auspicious day, and we'll be announcing.
Yeah, I think you had I mean, we have a very interesting set of things happening in India also. I think Bajaj has got a license to run a mutual fund, so they will launch their fund soon. I think Zerodha is in line, a bunch of others are in line. So we're going to see some interesting moves in mutual funds. I think in general, what we are talking about right now is we're in an interesting phase where अभी तक everybody was afraid कि inflation आएगा तो कुछ होगा, कुछ होने वाला है, some bank will go, some fellow will die. Some fellow died and was rescued. So that is over. Now we're going to the next phase, which is how many more will die because of this one guy dying, or the contagion effect. Abhi aayega, next 1 or 2 weeks, you will hear of contagion. But let us see where this goes. If there is no major contagion, we are done. And then the market should start showing the way upwards. Unfortunately, Indian markets have taken it on the chin this month already.
Yeah.
I think we're down like 4% or 4.5% in the last month. In March alone, we should be down some 3%, I think. Not sure. But essentially what we are is in a position where I think India is now weaker in terms of the market impact than the rest. It's also a very good time to invest in general, when everybody is afraid of investing. Because events have happened. The central banks and the governments have reacted. They have gone and protected the system. It is a very interesting system, to do things. I think overall, yeah. So resistance from, the strength of the banking system. I'll tell you something. You got an SVB, a Credit Suisse. Credit Suisse, all the 81 bonds were wiped out. 81 is additional tier 1. Even with all the additional tier 1 bonds going to zero, Indian tier 1 bonds continue to trade at a fairly high rate. And I can tell you, I don't know whether it is there now, but let me see if I can search for it and quickly show you what is happening over there. I just search for bonds traded today. Let's look at the corporate bonds trading. You should see the numbers over here, and let's search for this word perpetual, because that's what it usually is. The State Bank of India perpetual 7.75 bond is trading at 8.2%. Nothing. It's not trading at the 9, 10, 11% you should be trading at. It's a fearful situation. And of course, there are some things that are trading at 12%, like Spandana, which is obvious. No, they're a weaker NBFC, microfinance. So therefore, you'll see a higher rate. But you see now some of the others, HDB Financial Services for 2026 is trading only at 8.25. And this is a small NBFC in relative comparison. Indian Oil Corporation, which is 1 year loan, 1 year thing, is only trading at 7.68. 1 year government credit is trading at 7.2 something, 7.24 or something. The spread is still very low and shallow. If I look at perpetual bonds, the private perpetual bonds, which is in, these are still again Cholamandalam, which is not even a tier 1 bond. It's a perpetual bond by an NBFC that's trading at 9%. This is again not much. It should be trading if you're afraid of the market. This is how your longer term yields should be trading, and perpetual is the longest term yield you can get, right? So you're not getting the same fear here as you're getting in the West and all that. So our banking system seems to be a relatively much better and more stable situation. What is more interesting for me is what happens in Europe and how that impacts us. Hopefully, it won't be too bad. But the US and India, I think, right now are in much safer territory.
Also, what we are seeing is that the intensity of the fall is actually reducing with every bad news. For example, India has fallen a lot for first with SVB, and the intensity has been less for Signature Bank and much less if you compare with Credit Suisse. So the bad news keep coming up, but the intensity of the fall is kind of reducing. So it's kind of a good sign.
Very interesting, man. I think the next few weeks will be fun. Hopefully, we don't have too many of these things, but when the situation gets bad, we will do it.
Yeah. Don't predict.
Awesome.
React.
Okay, so on that note, don't predict, react. We'll wrap up this show. So, folks, thanks for joining in. We are on Twitter at @capitalmind.in. So, if you have any feedback on these shows that we are doing, you can drop us a note there. Share this video with your friends, whoever be interested in listening to this. There's somebody writing the word Hindenburg in the comment section. So that's an episode right there, which is.
Malao. Bring it on, man. Bring it on. First of all, it'll give some Hajar content. You have to read all of that.
Yeah.
You'll say, okay, this close
It took
brother-in-law is
1 week to read the entire Adani report. Entire 1 week.
no. And that Adani Green, man, it's going only upper circuits in some 3 weeks now. So I don't know what is happening, but Hindenburg is like, short-term impact, then seems to be changing everywhere. ChatGPT summary. Yes, ChatGPT summary. I'm wondering if there's a big report, we have to run it through ChatGPT and say, ChatGPT come back and say, guys, this is
I actually
just.
Hindenburg report, right? It's so big that ChatGPT will not accept it. I tried actually, but it'll just throw that there's too many lines and words to actually put it in a summary. But let's see.
Oh, yeah, let's see. I'm sure somebody we'll split it into parts and we'll say, see what it is.
First, we have to ask ChatGPT to split it into parts and then ask it to analyze.
Okay.
And then
Everything is meta. Then you ask ChatGPT, what question should I ask you? So that you will split it into parts. And then we will ask you the question to split it into parts. And then we will ask you how to.
And link ChatGPT with my Zerodha broker via API and ask them to trade and do whatever they want with that information.
Whenever you feel good about your life, just buy that time.
Yes.
Awesome.
Okay, so on that very casual note, we'll end the show. Thanks everyone for joining in.
Thank you, everyone. Bye.
Bye.